The way you buy a business can matter just as much as the business itself, because the wrong structure can leave you owning problems that you never meant to buy. I'm Taylor Rens with Zimmer and Rens, and today I want to break down one of the most important decisions in business acquisitions: the difference between an asset purchase and a stock purchase. If you're buying or selling a business in Wisconsin, this choice impacts your taxes, your risk exposure, and how smooth or complicated the deal becomes. My goal here is to give you a clear, practical understanding of how each structure works and why one might make more sense than the other, depending on your role in the deal. Let's start with an asset purchase. In an asset purchase, the buyer is purchasing specific assets, not the company itself. That can include equipment, inventory, intellectual property, customer lists, and sometimes certain contracts or employees. The key point is that the buyer gets to choose what they're buying and what liabilities they're willing to take on. From a buyer's perspective, this structure offers strong risk control. You can avoid unknown debts, lawsuits, or obligations tied to the business's past. There are also tax advantages because buyers can often step up the tax basis of the assets, which can mean more depreciation and amortization over time. The trade-off is complexity. Asset purchases usually require more paperwork because you have to do asset assignments, new licenses, consents to transfer rights under contracts, and that can slow down the transaction. Now let's talk about a stock purchase. In a stock purchase, the buyer purchases the ownership shares of the company itself. That means that the legal entity stays intact along with all of his assets, contracts, employees, and yes, all of its liabilities come with too. For buyers, the benefit is simplicity. Contracts and licenses typically don't need to be reassigned, operations continue seamlessly, and the closings can tend to happen faster. The downside is risk. You're inheriting everything, which includes known issues and unknown ones, and there is generally no tax step-up on the company's assets. That's why buyers need very strong due diligence in stock sales. Here are the big takeaways. Buyers often prefer asset purchases for liability protection and tax benefits. Sellers, on the other hand, often prefer stock purchases for simplicity and favorable capital gains treatment. In Wisconsin, asset sales may also trigger state sales or transfer taxes, which makes the proper structuring even more important. There is no one-size-fits-all answer. It depends on the business, depends on your risk tolerance, and the tax strategies on both sides. If you're thinking about buying or selling a business, this decision should never be made in isolation. Legal and tax guidance, especially from Wisconsin-based professionals, can make all the difference. If you want more practical breakdowns like this on business contracts, acquisitions, and deal structure, follow along with us here. We regularly share updates to help business owners make smarter, more informed decisions before they sign on the dotted line.